This is a new innovation. All right, let's kick off the final panel. My name is Brad Bernthal. I'm an associate professor here at the law school. Among other things, I teach in the world of venture capital. We're going to be talking about the investment perspective here. I'll do a quick introduction down the panel, and then I'm going to invite each of the panelists to speak with respect to quickly the area of investment that I am engaged with or that I know, and this will give you a little bit of perspective. Quickly, to my left is Nicole Glero. She's the managing director at Techstars. For those of you who are not familiar with Techstars, it is the world's leading accelerator network. And to my mind, Techstars is probably about ready to be added to the list of companies out of Boulder that have created an entire industry, or at least been part of creating an entire industry. To Nicole's left is Jim Linfield, who's a partner at Cooley. And in terms of someone who's been part of helping many of the companies over the years, including several that have created industries, Jim's vantage point across multiple sectors in the Front Range is really unparalleled from a fundraising perspective. To Jim's left is Jim's left, your right, is Bill Perry with Infield Capital. To Bill's left is John Siegel with Columbia Capital. And then on the end is John Wallington from UPC Capital Ventures. Nicole, just to provide a little bit of framing for the panel, the area of investment that you know or most closely involved in, just to give people a perspective as to where each of the panelists is coming from. Go ahead.
Sure, so I'm most familiar with the pre-seed, seed, and up to Series A investments in early stage software and web companies.
Jim?
I've worked across all the industries. A couple that I may talk about later would be some in the clean tech space, and then also a lot of interesting things going on in omics, which has more to do with this than you might think.
Bill?
I'm a clean technology venture investor, and we specialize in early stage and middle growth.
John?
I specialize in internet infrastructure, enterprise IT, more focused around services around the cloud space.
And conveniently, we put both Johns next to each other to maximize the chance of confusion on this panel.
Our accents are much different.
Distinguish John on the end in terms of the accent.
So UPC are primarily a developer of wind and solar projects, and we've also had experience in oil and gas, property, mining, other areas. Our focus for UPC Capital Ventures is really to go upstream on the energy technology, energy efficiency, sustainability, and also LOHAS side, in particular getting into the water business, because I think there's an inextricable link between energy and water. And so we've made a couple of recent investments in the water side, and that's an area we want to expand in.
Very cool. So what I've got in mind for the next 45 minutes of panel discussion is we're going to cover 4 topics. The first is, in terms of disruptive innovation, what's getting funded. Second, what's not getting funded but potentially should be. Third, are there any interesting models of investment that are innovative, that are emerging, that you're seeing? And fourth, we'll talk about some of the regulatory threads and how that bears on investment in the areas of expertise that we've got. As a broad, useful enough prism, the distinction between disruptive innovation and sustaining innovation, we'll try to use the Christensen type term. By the way, for those who didn't see it this summer, there's a great back and forth about disruptive innovation as a topic. One of the former HBS students went after Professor Christensen. It's a fun change. Just check it out if you haven't looked at that. But the notion being that sustaining innovation is something that's more incremental, that it's developmental along a smooth expected curve, whereas the disruptive innovation is something that's creating an entire market just off the development curve, often coming from a somewhat adjacent space. So we'll talk broadly about disruptive innovation as it intersects with investment. Jim, maybe I'll tee you up first because you see across several industry sectors, and we'll drill down on this. What are you seeing getting funded that's interesting with respect to disruptive innovation right now?
A couple of different areas. I'll pick LED lighting for one. Thomas Edison's light bulb from 1879 really should have been called a heat bulb because 95% of the electricity went to heat. So CFLs are about 6 to 7 times better than that, the ones up there, and then LEDs are 3 to 4 times better than that and last 6 to 7 times longer. So that's pretty interesting in itself. But the LEDs are driven by semiconductors, and so that opens up all kinds of new possibilities for smart lighting systems that can provide a variety of valuable features to generators, to building owners, and to users. All right. And then the other thing that's happening is the price has dropped so fast that the payback periods on retrofit are now down to can be less than a year. So that opens a whole new market because that market is 20 times bigger than the new construction market. So to me, that's a pretty interesting area. Another one I mentioned briefly were the omics, genomics, proteomics, metabiomics. And these really represent the convergence of 3 technologies. So you have the internet to transport all this massive data that's being collected. You have high throughput sequencing, which make a $100 genome, something that you can see on the horizon, and a $10 genome, something that you could dream about as opposed to maybe hallucinate about. And then lastly, big data analytics. So the combination of those things is going to power incredible advances in diagnostics, in treatments, in design of new drugs, and it's going to happen very quickly and very inexpensively.
Just because you teed up the lighting on the front end, maybe John W. on the end to be a natural to go in terms of what you're seeing. I know that clean, sustainable energy innovation is an area of interest for you. Let's pick up from there.
Yeah, absolutely. And I reiterate Jim's point on LED. It's an incredibly exciting area. Not only in terms of what it actually brings to wider communities in terms of the ability to get relatively cheap, affordable, but also energy efficient lighting. So we're actually in the final stages and closing on a deal with an LED company. And that is a platform for us to also look at other types of technologies. So another area that we're personally interested in is the algae technology. Or the ability to use algae for water purification, to create nutraceutical drugs, carbon sequestration. The advances in LED technology, applying those into something like algae farming is actually pretty significant. And you can fundamentally change the capacity that you need in terms of land area to actually generate high volumes of algae and a whole plethora of follow-on uses. Other areas that we're very excited about, microgrids, microinverters. We've been an investor in a project for a number of years that for various reasons stumbled a bit, but our good friends at Google came to the rescue, and that's a very exciting project looking at microinverters.
What's a microinverter?
Small-scale inverters, which, for example, on a solar installation, you can dramatically increase your efficiency. The concept of energy harvesting. So on a rooftop PV site, you're actually harvesting energy a lot earlier in the day. And also there's some added benefits, the ability to look at different types of energy, so reactive energy. There's quite an interesting sort of angle in there, which I won't get into too much detail on.
No, it's perfect. Bill, let's stay with the area of clean tech and energy. What are you seeing?
Very good. Well, the whole vehicle electrification, vehicle hybridization space is continuing to move very rapidly, and money's flowing into those arenas. The battery space gets a huge amount of attention, and all of you will see press pretty regularly on that front, everything from small-scale entrepreneurial work all the way up to Tesla-scale operations. Jim was talking about how disciplines are coming together. We're invested in a company called Wildcat Technologies that actually takes biomedical chemistry research testing tunnels, where they have these highly automated testing systems where one tunnel, which costs you a lot of money, will reproduce the work of 1,000 lab bench scientists. And they're taking that know-how and they're applying it to battery chemistry research. So we're going to continue to see galloping advances in battery. And as I think many of you know, half the cost of a Tesla is the battery pack itself. And driving these costs down is going to have a real accelerating effect on these disruptive technologies. Moving aside from batteries, an area that is much less well understood and covered is what's called the power electronics inside these complicated systems. And a huge amount of efficiency at this point is still lost there. And at the heart of it is that the EE work is not as sophisticated as it can be, and the material science needs to advance. Silicon chips are just not very good in these high power applications. And there's a lot of very encouraging material science there around gallium arsenide, around silicon carbide. And this intersects with what John's talking about, because the same chemistries and chip formulations that are so promising in these controllers for EVs and hybrid electric vehicles also are showing up in LEDs. One of the pleasures as an engineer and businessman is living in a time when all of these disciplines come together.
Let's move over into information technology. John and then Nicole. John, what are you seeing that's getting funded these days that you think is truly disruptive?
Well, I think if you take and it kind of hits on some of the themes that have been brought up through the conference today, but if you look what's happening with compute power, let's just take a step back at, really macro kind of theme here, and you compare it to when kind of the electrical grid got rolled out, in the earlier part of last century. What it enabled was a lot of chores, a lot of things that people did on a daily basis were then automated via electricity. And that kind of enabled a vast change in the way that people were kind of living their lives. And with the massive amount of compute power people can access now very, very cheaply in a really scalable fashion, we can take it up and down, where, I think you're sitting in one of the more unique periods in kind of investing, at least kind of around information technology and kind of in the space at least where we look at, because there's technologies right now, and you could just use enterprise software. I mean, literally, I say that 4 times and half this audience will be asleep, except the guy from Microsoft who was here before. But you look at those applications, a lot of these applications, for example, are huge markets. You've got a captive customer base that is basically, and there's kind of an analogy that one of our CEOs uses. There's, you can play in one of 3 levels in IT. You can play in the air level, where if you don't have it for 3 minutes, you're dead. Water, 2 weeks, or food, like whatever it is, a month or something like that, whatever it is. And the air level of kind of enterprise IT, there are a lot of enterprises that are hostage to systems right now, where data is trapped. You've got recurring cash flows, and people are taking kind of exorbitant rents from those guys. I think that's a huge opportunity that we see, at least in our little microsphere. You apply that same type of analogy to other industries, other opportunities, and that's where you get kind of the breakouts, the Ubers that come out of nowhere, but it's accessing that compute power, all this technology that's now been stitched together. So where I see it, I really see it around enterprise IT with a lot of kind of trapped customers you can kind of finally release. But I think the ultimate ramifications of what this unleashing this compute power has is, look, I mean, Netflix killed Blockbuster, right? Netflix runs on AWS. I mean, it's just you can see the dominoes we get into.
I was blown away by John Levisay's comment on the last panel that your healthcare costs are greater than your technology costs in terms of running what's ultimately a tech company. Fascinating. Nicole, what are you seeing?
I think that the connected home right now is a really hot space, at least in terms of tech, and just being able to quantify stuff that's going on in your home. In fact, at Techstars, we just funded a company that is doing what we call home awareness, and they're literally like these little sensors that are about this big that have 8 different sensor types in them, and they can detect almost anything that's happening in your home. And just like the notion of connected home and more data around what's happening in and around your home is really exciting. I think
Want to plug your company?
Not yet.
Okay.
They have a Kickstarter campaign next week. I'll plug it then. But another area that I think is really exciting is the self-driving car space. I just think that's game-changing, right? I think from a transportation perspective, what's happening with self-driving cars is really interesting, and I love that you've got states like California that are making it legal to actually have these things on the road. I think that in a decade, like, we just won't own cars anymore. you'll just take a self-driving car wherever you want to go. So I love that space. I totally buy into the data and analytics. That is, I should say data analytics and data science. I think that data scientists are the next like millionaires in the world, because those guys are going to have the key to unlock all of the information, and information is power, right? So to be able to go in and look at a data set and really extract value from it is it's an art, not a science. And those guys are going to really hold the keys. The way that applications are built and deployed is something that we're paying a lot of attention to, at least at Techstars. The speed at which they're getting to market, the number of lines of code that these guys have to write to get them launched, the cost to get these products launched is really critical. So we're seeing a lot of stuff in what we call container space or Docker space. That's really interesting.
Can you give us an example?
Yeah, and there's a company that we just funded in New York whose name is totally eluding me at the moment. I'll think of it right when I don't need to think of it anymore. But the Docker space is actually super. There's like 2 or 3 companies that are playing in that space right now, which is really interesting.
So, go ahead, sorry.
No, that I was just going to say those are the areas that at least I'm paying attention to, and I've got interest. I would say that the most interesting area though is still probably in data and tech in healthcare. So I love that comment, because when we can unlock I should say not just in healthcare, I should say in science. So as we can look at these large data sets and start to extract meaning and value from them, everything gets like smarter and less expensive and faster. Everything from healthcare to finding new drugs for cancer to everything. So we're looking at a lot of stuff in that space.
All right, that's the last time I was moderating in this room was science fiction and entrepreneurship at conference. One of the sci-fi writers, more or less said, I no longer think that I'm inventing things because innovation's actually outpacing science fiction, which is kind of an interesting this menu of tantalizing possibilities suggests that. But what are you seeing that's not getting funded? And I'd be interested in why you think it's not getting funded, whether the problem is regulatory risk, disfavor with limited partners for whatever reason, or just uncertainty about where the market is going, or some other reason. And Jim, maybe I'll turn to you first in terms of what are some disruptive innovations or companies that you see that, in your estimation, should be getting funded but aren't?
Well, one I can think of is a significant improvement in the design of generators for wind, and it's hitting the market at a time when the big companies are thinking very short term. And this is technology that someone's going to do something with someday, but it's all about timing. It's, you have very long design cycles to get into this stuff, and you have to have the staying power.
Others?
So, I'm not a huge fan of fossil fuels, but they're going to be around with us in transition for several decades yet. And we see a regular flow of quite radical improvements to internal combustion. And there's this very significant disconnect between the long lead times to get these adopted by volume manufacturers and the amount of money that's required and the kind of patience that's required from investors to back those kinds of plays. So that's a disconnect that we see quite routinely.
Give us some time horizon here in terms of internal combustion. You see a promising technology. How long from, say, seed stage funding to actual deployment in the market?
Yeah, you're in the order of 10 to 15 years. 10 is aggressive for mass production deployment. And it makes it quite difficult. And we're going to see, though, some disconnections, because when you look at the pressure that the vehicle makers worldwide are under with higher and higher, tighter and tighter mileage and emission standards, their whole system, the way they think, the way they adopt technology, the way they validate technology has such a long time cycle that's out of step with what they need to achieve over the next decade. So it's going to be very interesting to see how these big organizations creak and groan as they are stressed to innovate more rapidly.
Yeah, when I hear about long lead times, I convert it not into years, but into quarters, because that is the unit of time in which big companies think. And 40 quarters is a long time.
Yeah.
So that's what I was going to say is in my world, stuff, they're looking at lead time, or they're looking at return on investment between, 5 to 10 years. So anything that's like longer than 10 years tends to not get a lot of love. But in my opinion, when we look back in the US history, some of the most huge technological advances were people that took massive risks that had like really long timelines. And it's almost an unfortunate way that at least my industry has developed, that we sort of time box ourselves into these, that we need to see returns in these amounts of times. Like things like space travel, like we got one company or two companies of note that are really trying to innovate in that space. And man, that would make a huge difference, or huge advances in even like just aerodynamics and how airplanes fly. I mean, when was the last time we saw massive innovation in a new kind of airplane? It's been decades, right? So like, I feel like that stuff, I should say, like, I feel like that stuff's not getting funded, but the other side of it is that I don't actually know if there's people working on it, because they don't come to us because we're not the kind of people that can fund that stuff, but I hope they're getting funded, or people are innovating somewhere.
I think, going back to the point on fossil fuels, given the tremendous amount of shale gas that we have in this country, it's a shame that the infrastructure isn't developing at the same pace to actually utilize that. And, if I think, I spent most of my years living in Europe, and 20 years ago, you could go to the Netherlands, and there was, liquefied natural gas at, your average gas station. People were filling up, had the choice between, conventional gasoline, petrol, or they could use LNG. And the fact that we have so much in this country, and there's not enough being done on the infrastructure side, particularly for vehicles, to have, why aren't FedEx fleets, why aren't local, school buses? It may be different in Colorado. I have to admit, I live in Florida, and things are a little bit backward there. But, there is a tremendous opportunity. I understand there's a lot of capital that needs to be invested, and, as Nicole was saying, there is a time lag. But, by all accounts, we're going to have ample natural gas reserves to last us a long time, and we should be taking those steps now.
What's your account for why more infrastructure is not being built, invested in along those lines?
I don't know. I mean, I think, to some extent, shale gas has been around for a number of years. I think the speed and the rate of discovery has taken a number of people by surprise. When you look at the valuation of reserves, and you look at some of these wells, I mean, I mentioned we have a small oil and gas business in rural Pennsylvania, which is the home of the Marcellus Shale. We cannot sell our gas. Nobody's going to buy our gas. All the storage fields are completely full, and people don't know what to do with it. So as a result, the price has dropped significantly. But I think it is a sign of just a lack of thinking that this revolution came along quite quickly, and the infrastructure at one point was very much trying to ship oil from Texas up to the Northeast. Now, in essence, all of those pipelines that have been built are in reverse. You actually now have to ship gas down to the south. And that's really changed the whole concept of how we're going to utilize these resources.
John S., what are you seeing in the way of disruptive innovation that's out there, but really struggling to get funding, and what's your account for why?
Well, I think you've got the wrong people on the panel to ask that question, honestly, because I think you need to go to my sense is if you look at the markets right now, the guys in Silicon Valley have a lot of capital. They're putting a lot of money to work. There's probably been more money put to work in Silicon Valley over the past few years than going back to the tech bubble. I think people's risk appetite, there's a lot of money sloshing around the system. The risk appetite's low. So if you're asking a bunch of people who are paid to put money to work, where are the opportunities that aren't getting funded? We're probably not doing our jobs if we're not putting our money into those fields. The guys, it's the entrepreneurs who are not getting funded really have the answer to the question.
Well, let me push back on this. So you're right in one respect, in that this is class, right? If we had 6 entrepreneurs up here, they'd all be saying, well, I had this great idea and I couldn't get it funded. And investors are like, well, capital eventually reaches good ideas, and there's this classic discussion. Let me put it this way. When you go out to talk to your limited partners,
sure,
what do they not want to hear that you're funding?
They do not want to hear that you're putting a ton of money up front into a company that either is doing a lot of infrastructure, or you're putting a bunch of money at risk before you have a sense of if the market's there. So I'll call it, anyone who's around venture capital is one of the more overused terms in the world is build it and they will come models. The ability right now to innovate and get market response is so fast because of the lowering cost of technological innovation is such that, where guys like us get in big trouble is you got a big old check into something before you figure out there was a market in it, and everyone looks at you like you're an idiot. And, I've been in enough of those meetings, I don't like to do that very much, so try to avoid that as much as possible. But I think I am sure there are huge parts of the economy where there's innovation that needs to get funded right now, but there's a lot of money sloshing around too, chasing people. So I think that, again, I think we're probably the wrong people the panel will be asking.
Jim, you mentioned onomics or omics, so
Right.
proteomics, genomics. At least locally in Colorado, there's some sense that this is a real challenging sector to get funded in. At the same time, for those of you who are familiar with SomaLogic, this is a company founded by Larry Gold. Potentially could be a very nice outcome. We'll see how things go in the next year or two. That's a proteomics company. What are you seeing locally in the world of bio and life sciences, and is this a problem in terms of funding cycles?
There's a couple of very interesting companies doing microbiomics here. One is based on Rob Knight's work at the university, and he's doing stuff all over the place, from therapeutics to, believe it or not, using bacteria as subsurface sensors to determine the presence of hydrocarbon. So, it's unbelievable stuff. And then there's some interesting, new sequencing technology that's being developed too. So that if you get out beyond that into therapeutics, there's a problem industry-wide and in Colorado that it takes an awful lot of money, and you have, probably the biggest fear people have out there is of capricious action by the FDA, and the FDA has killed some good companies, including some right here, because they changed their mind. And when the FDA changes its mind, it may cost you 24 months and $100 million, right? Well, that's scary. That's scary to venture capitalists. So right now, the public markets have been very interested in supporting biotech. So there's now, here and around the country, 100 companies that have gone public and now have the capital to advance things. But it goes through cycles that have a lot of amplitude in the biotech funding.
So let's use that as a departure point to talk a little bit about models of financing, and just to maybe disclose a little bit about the structures that you each are most familiar with. John, let's start on the end, just in 20, 30 seconds. Talk about the structure of the funds that you put to work, and then we'll go down the line real quickly.
Okay, I think, because we actually fund our investments off our own balance sheet, so we are not beholden to external investors. It's all privately funded. It's our own cash that we're putting to work. We can be incredibly innovative and entrepreneurial in the way that we look at opportunities. A lot of time, in a lot of circumstances, particularly if you're funding a company which is, you're basically investing in the founder, it's their love, it's their life, it's everything they put into it. They want you to be incredibly accepting of their views, and on that basis, we are very flexible. We can work with a variety of different models. We don't have an internal investment committee. It's our own money. We talk internally, and we come up with a structure that works for them and works for us. On the same line, we also don't necessarily have very strict timelines. We're not under pressure to exit a fund within a certain number of years. We can take a decision that this could actually be a very good yield, and we're just quite happy to stay in there for a number of years, or alternatively make a quick exit as well.
What would a typical size of investment be for your fund?
At the moment, they vary. We've only set up capital ventures this year, so we've only closed on 2, and one of them was in the several $100,000, one was in a couple of $1 million type range.
John, you want to talk about Columbia?
Sure. So we operate in what I call traditional alternative investing framework. So we have generally raised funds around $500 million from LPs, state pension funds, insurance companies, et cetera. Put that money to work. The way that we tend to invest is, and it gets down to style effectively when you get to different venture capital firms and different investors' approach. Our approach is very, very, we've defined ourselves by sector, and then what we try to look for is disruptive business models that either play on a derivative trend in a sector that we know well. And then we, frankly, ultimately, it all comes down to the management team for us. And so whether it's starting with writing plain checks for Dan Caruso to go around and try to dislodge some, distressed fiber assets, or it's working with a company, here in Boulder to do something around kind of innovation around video surveillance. It's the management team giving them enough money to see if it's going to work, and if it does, then you drop the hammer and you try to put the money in.
You guys are a 10-year fund, $500 million in the current fund, and how many funds do you have active? What number is this for Columbia?
We're raising Fund 6 right now.
Fund 6. Okay, Bill.
I think Nicole spoke very well about the tension between the conventional venture model and the timeframes that are involved in so much of the exciting stuff that we can see and taste at this point. And in some ways, clean tech venture capital is an oxymoron. The two funds that I'm active with, Infield Capital and Vision Ridge, have different kinds of money models on the inside. Infield Capital is funded by strategics, in other words, industrial companies who are accustomed to industrial timeframes to evolve technologies and who are far more patient than the typical venture investors who are likely to be in funds like John's. The other fund is funded by a single wealthy individual who's very committed to this field and again is an unusually patient early stage investor. So, it's very important to align the timeframes of your investors with the timeframes of the deals that you're pursuing. The other thing I'll mention, where there's been a big space in the market, and I think you'll see some news here locally before the end of the year, to drive disruptive change, a lot of things we need in clean technology are invented or reasonably well proven, and what's missing is the project finance piece. You're talking much larger dollars, and conventional sources aren't taking those risks. So an interesting fund is coming together where people with highly specialized knowledge about these technologies and their applications, along with deep financing connections around larger pools of money, 9 figures rather than 8 figures, are putting together an acceleration fund to drive more rapid adoption of technologies that are sufficiently proven, but where conventional bankers for this kind of things fear to tread.
Maybe, I know you're not operating a fund. Maybe I'll have Nicole go first, then you can observe if there's other structures that are out there that you're seeing that are interesting. Nicole?
Yeah, I mean, our fund is pretty small. We write small checks around $100,000. And while we do have external LPs that fund those, we are given quite a bit of flexibility in terms of what we can invest in. But we really stay focused on what we're good at, which is web and internet software. So when we venture outside of that, we tend to do really poorly. We make bad decisions. So, but staying inside of that is what we do.
So I probably spend more time in what I call the mainstream venture capital market than anything else, and those funds look pretty much like they did 30 years ago as far as the basic economic terms and the duration and so forth. And the typical deal structures, the Series A and Series B financings, look pretty much like they did 30 years ago. I think where there's been some innovation is ways to get the first $1 million in a company quickly and inexpensively. So, Series Seed preferred, which is kind of a de-scoped Series A, or convertible notes or things like that, that are really designed to say, okay, let's not spend any time or money on legal stuff. Let's just get this done. And I think that's been an improvement. And then I think the things that are going on with the programs like Techstars and the other accelerators that are designed, I think there's some innovation that's gone on in how you get these companies moving faster.
So let me frame what I think is a provocative question and put this out to the group. The VC model as we know it really kicks off in the 70s and especially in the early 80s. So it's a relatively new innovation. If you go back before that in terms of major innovation in, say, telecommunications, Bell Labs was an incredible engine. The laser, the transistor, cellular technology, just incredible stuff that did not come out of the VC fund type structure. So my question is, have we looked to the 10-year fund structure to do too much in terms of innovation, and instead of beating it up, maybe we should just acknowledge that it's really good for certain types of innovation, but that as a social matter in terms of net innovation, we really need to be more serious about other models and pushing them along. We don't have the utility model that funded Bell Labs. Query, are we losing some of the big innovation opportunities by relying too much on the 10-year fund? And maybe, John, since you've got a 10-year fund that's making big bets, we'll start with you.
Well, I'd maybe take a counterpoint to that, which is I think you do have big utilities making big innovative bets, but it's not a utility that as we think of utilities, it's Google, it's Microsoft. I mean, those guys are freaking utilities, right? I mean, it's not like people are, those guys, and the amount of cash they have, they have utility style economics in those business models and scale. And so the gentleman that was up here earlier from Microsoft talking about the kind of long-term investment they're making around artificial intelligence. I mean, those are the types of long-term innovative bets that a company like a Google and a Microsoft can make. So I don't think that our economy is bereft of those kind of funding sources. They just look different than kind of what we're thinking of corporate America kind of in the 1950s. But look where those businesses came out of, right? Google was founded by, venture-backed thing. That kind of, there are different roles for different kind of scale of innovation inside our economy. And I think anytime you feel like something is working really well, it means it's ready to get pushed over and you start over again, right? It's ready to be disrupted. So I'd say where we sit right now, a lot of the innovation and a lot of the true kind of bleeding edge stuff that's getting done is getting done inside those more utility-like companies, and people kind of are peeling out of them and starting. That's where you get the startup kind of feeding going on. But I do think that utility-style funding does exist in the economy right now.
So I would just add to that, there's a difference between venture capital, whose job is to produce returns, and research and development, whose job is to I feel like ideally, and I recognize this isn't an ideal world, but ideally you have low risk situations in research and development, which gives people an opportunity to be extremely innovative. So failure is great, fail, awesome. Let's keep trying crazy stuff. Doing that in a VC world is a lot harder because it's not that the stakes are higher, it's just that you've got people looking over your shoulder wanting returns. So I think you have to do a mental model of separating those two things out. And as long as we have entities like Google and maybe even the U.S. government funding R&Ds for certain places that are doing pure R&D, that's great. But I don't think we can ever think the VC community will do that.
I couldn't agree more. There was a wonderful cover last year. I don't know if any of you saw it. The front of MIT's Technology Review had a very dramatic picture of Buzz Aldrin on it, the astronaut, and even in his 80s, this guy's still a serious dude, and he's still fully engaged. And the subtitle was, "You promised me Mars, and I got Facebook." And venture fits really well for certain kinds of activities. And fortunately, we do have both new and traditional corporations that have major R&D budgets. I point to ARPA-E as a great example of government doing innovative and creative and economically efficient work to seed important research that just isn't going to get funded other ways. And, we've seen that before. I was close to the original Human Genome Project in a couple different respects, and that wouldn't have happened without an unusual approach to R&D. So I don't think venture is intended to be a one-size-fits-all, and there's a lot of stuff where we need research and not just scientific, but commercial development that venture doesn't fit.
Mm-hmm.
Yeah, there's, I think VCs in general are savvier about trying to figure out what the time horizons are going to be because they invested in plenty of 5-year deals that turned out to be 12 or 15-year deals, and that didn't turn out well. So I think there's, I think more careful in the earlier stages of thinking through the risks, the sales cycle risks, the adoption risks, all those things in some areas. But it remains a great fit for a great number of companies. And then the key thing is for the entrepreneur to recognize when maybe what he or she is pursuing is not the right fit for the VCs, because you have a lot of meetings that end up without any interest, and you ought to be spending that time somewhere else.
Let's talk a little bit about regulatory risk as it affects investment decisions within your ambit. Where do you see regulation, if at all, chilling disruptive innovation that should be occurring in your estimation? Jim, you want to go first? You talked a little bit about the FDA.
FDA. Did I mention the FDA?
Can you give us a specific in which, and more importantly, what sort of fix would you propose at the FDA that would help?
I think there's a cultural. So part of the problem is there's no upside for anyone there. There's only downside if they make a mistake, and the image that is emblazoned in everybody's vision there is of thalidomide. That was the agency's greatest moment because they did not approve it, and it was approved in Europe. Okay, and so everyone at the FDA lives in fear that somehow a thalidomide slips through. So the degree of risk aversion is extraordinary. Now that sometimes is okay, but they have no concept of how decisions that they make impact innovators. So they tell somebody to run off and do a bunch of new tests that take 2 years and $20 million. That may be the end of a company, and that's just never occurs to them. So I think having a little bit of understanding of what it takes to build and grow a company. Now, at the end of the day, they have their statutory mandate to make sure that things are safe and effective. But I think there's a lot of tunnel vision there and risk aversion.
John, in the world of telecom, do you have any thoughts about this?
It's a great question because our industry, and if you look at the telecom side of what we do, goes through periods of high regulation and deregulation, and it is a business generally that when you get scale, that's when you're making the most money, right? It's a business that leads itself to scale. As you get more and more scale, that's when you take a dominant position in the market, you can snuff out innovation very, very quickly. So, if I look at someone like, the cable companies now and what they're doing in terms of their ability to cast a long shadow and really kind of have their position is getting to be so dominant now on both owning the customer in terms of access, in terms of owning content and determining what we watch, how we watch, and how that content gets delivered to the, again, it's a model that ultimately with over-the-top video, you can see how it gets disrupted, but it's a business that lends itself to economies of scale. You get those economies of scale, which are great and profitable, but then it gives them a big wallet to go and lobby against. I would say, just as an anecdote, the chairman right now of the FCC, I think is someone who is pushing and creating an environment where there's probably more open to innovation than we've seen in probably, close to 20 years, is my guess. Is that about right? Yeah, my math's right, about 20 years.
And that's a nice plug for the Digital Broadband Migration Conference here in February when Chairman Wheeler will be here. And so we can take up that question with him. But just to...
I appreciate that. I'm sitting next to him in the panel, right? When we're having the conversation.
One implication of your observation, and so if you think about conduit and content coming together in a certain type of market power that a cable provider may have, this is the impetus for net neutrality concerns and people calling for the FCC to mandate a certain type of neutrality that prevents the conduit provider from leveraging that power into content. Do you think that the FCC is handling that the right way so far in terms of cultivating innovation?
I think, we talk about, the gorillas having power. Comcast, again, their business model is not timeless. There's a certain time frame in which their business model is really powerful, but their integration into content and what they're able to do is potentially stifling. And they've been given kind of a nice runway to kind of go at it. I think we'll see how this chairman reacts to them. But again, that model works great now in this time being. Over the top video and other ways for people to get broadband. It gets disrupted, but it is potentially stifling right now, and you can see it.
Nicole, in your world?
There's a huge debate in our world on software patents and whether or not they are, they're worth their weight. And we do see a lot of innovation that's somewhat stifled by those patents. It's a super complex problem and one that I won't pretend to, have the answers for. But when you do have organizations that have very, very broad patents that then either try to protect those patents or when you've got other patent trolls out there that specifically buy up broad patents and their whole business model is in suing companies over patent infringement on things that's not even really infringement. It's absurd. So I would say software patents is an area. I think stuff that we're seeing a lot in the news today is probably in the transportation and hospitality industries with what's happening with Airbnb and in New York City and Uber and in certain cities, right? So I do think that what you see is a lot of entrenched organizations that are like, this is my space, back off. And that's really keeping the startups from being able to innovate on those spaces because they're afraid. Like, you want to try to go up against a big organization like that, like, you're going to lose every single time. So
let's linger a little bit on Uber, because to me, the story is not that entrenched incumbents are fighting Uber. Of course, it's in their business interest to do so. This is, as long as we have regulation, this is going to be the way it is. The story is that the upstart is kicking everybody's ass. It's amazing that Uber even has a chance in the most regulated of industries. I'm wondering, does this portend a different type of future, or do you guys just see this as an exceptionally well-funded, well-executed effort, and for whatever reason they picked incumbents that they can win against? Is there anything like it, and do you see this as a playbook that can be replicated going forward?
It doesn't work everywhere. So I think they've been very clever with the sort of cat and mouse game they've played. Very, very clever to build up, not ask for permission necessarily, you just start business, right? You can't do that with a drug, right? So there are
Legally.
illegally, yeah.
How about in the world of energy?
Clearly it goes without saying that any investor is going to take a huge amount of risk on any venture. The one thing you want is to make sure that your regulatory authorities and your government are behind you. If I look at the history, particularly going to the wind and solar development side, and the way that we've had this merry-go-round of debate and discussion on the extension of investment tax credit and production tax credit. And it's just highly inefficient to try and run a business waiting for the government to make a decision for you then to enact your plan because everyone else is waiting for that decision. So what you find is you get this incredible sort of spiral up and down of, everybody's waiting, costs go down, decision is made, everybody wants to get into the same market, costs go up, your returns go down. So, I think that's one key area which has been incredibly frustrating to be working on within the US. I would extrapolate because, for us, what we found in the industry over the last, few years, post-financial crisis, is that competing as a small, privately owned business, competing with large, well-funded multinationals, it's a very different ballgame. So the way that we have compensated for this is that we've actually gone out and found new markets. So we are actually, very prevalent in emerging markets, frontier markets, places like Indonesia, Philippines, China, North Africa. And what you see there is it's a different problem, and it's a different sort of set of rules that get created by the regulatory authorities. They have a demand for energy which is different from the demands and the conflicts for different energy sources that we have here. So, I take a place like Indonesia, you've got a number of different, it's a very, if you imagine the geography of Indonesia, lots of disparate islands. Very few of those are connected to a grid of any sort, and whatever grid it is incredibly draconian and is either diesel-powered or coal-powered. So you go to these places and you say, look, this is what we need if we are actually going to put in place a project here, and the government or the regulatory authority or the utility is totally compliant. What do you need? Well, we need a transmission line. Tick. What do you need? We need a road. Tick. So you're working in a different environment, and some of these are control and command economies, but they are really, their desire to find a solution is way more sort of extreme than you get in more developed economies. So it's kind of interesting when you're looking at, places that are actually very undemocratic, you can actually get a lot done very quickly.
I just, I think that the point that was made by Uber in the panel before this, which is, if you're going to play in a regulatory environment against a regulated kind of incumbent, go against one that everybody hates, right? I mean, Dan's made a ton of money for people over there because guess what? Everybody hates the phone company. I mean, sorry for the gentleman from CenturyLink over there, but people generally. Yeah, okay. Everybody loves the cloud. So, but I think when you talk about companies or industries that people feel warm and fuzzy about, regulated telecom is not one that people say, boy, I love dealing with the phone company. The next one is, how many people in this room have had a near-death experience in a taxi cab? I bet a lot of us have, right? And so that's a pretty easy one to pick on as well. So if you're going to go up against, a regulated, someone who's got some regulatory authority, go against one that people just, there's kind of a natural common sense people hate. And generally, even in Washington, and we swim in those waters all the time, common sense will win out. It may take a little bit of time, but if it's a really, I think a commonly held view that it's a poorly run industry, you'll get a little more leeway.
One final question, we'll go to attendees for questions. Jim said something in terms of regulators' incentives, and that is specific to the FDA, the fear of mistake is far more powerful than the reward for getting something out faster. And many regulatory agencies either have relatively slow timeframes for making decisions or sometimes no timeframes for making decisions. Do you think it's time that we seriously consider allowing for more mistakes out of regulatory agencies in exchange for the benefits to speeding along innovation? And is there a particular area in which that makes sense to you? I think the hardest one, Jim, is the FDA, right? Where the consequences probably literally are life and death.
And to their credit, they have developed some programs for accelerated consideration of life-saving medicine. So, cancer therapies that are destined for people that have advanced cancer. I mean, it's like, without something, what the outcome is going to be. So, there have been some innovations there. But I would say, in general, the culture is pretty risk averse. The other problem is, if you make a mistake, then you're in front of Senator Grassley or somebody like that. And I mean, that's just an awful experience for anyone to have to go through, is to get in front of the demagogues in Congress. And they are part of the problem. I mean, those egomaniacs that want to be on C-SPAN, it's a problem. I don't know what you do about that. We elect them, right?
It's always been such a crazy thing for me, at least from the FDA's perspective, because it feels like, at least from drugs, like if you're dying and there's an experimental drug that's in testing and you're going to die anyway, like, give me the damn drug. Let me test it, right? It feels like, people should be responsible for their own behaviors and allowing people to make their own decisions and be responsible for what happens based on those decisions. The FDA could be a little bit looser with people that say, I fully acknowledge the risks. I understand what's going to happen. No, the government doesn't have to take care of me if the worst things happen, right? Let me be the guinea pig here. And that feels, and I don't think they don't always do that. So.
All right, well, let's open it up for questions. And we've got, Elizabeth, we'll come to you second. In terms of the student preference or recent graduate preference, we'll open up there first. All right, come back here. And Eli, I'll point out the next question while that one's being asked. So go ahead.
Hey, I'm Brad Sands, 1L. You guys hit the regulation, and I really want to stay on that just for a few more minutes. Uber is getting knocked around. Sometimes FDA gets knocked around. We can't export our oil and gas, and that's why we're sort of capped. There's got to be something to get the we'll say the bureaucracy to move forward. And I don't know what it is. I know in a lot of ways the EPA gets held up because they say they don't have enough employees, and oil and gas can pay for literally the consultants to do some of their work and move permits forward. I mean, what is the process? Is there any way that you guys see an opportunity there to help them move things forward? Like I said, with the outsourcing and the EPA, anything along those lines?
So maybe I'll frame this. Is there a particular frustration in front of one regulatory agency? This would be a no-brainer fix that makes sense to you.
Yeah, given what I was saying about our experience in the oil and gas world and the EPA and also the DEP, the most tragic thing I think that's happened for various different reasons, for obvious reasons, was the BP oil spill, because suddenly the scrutiny that even a small company got put under meant that it was very, very restrictive in terms of trying to develop your acreage and develop your property, because suddenly you were just had a whole plethora of forms thrown at you. And I think there also needs to be an understanding of what it is that you as a company are and what is it that you're trying to achieve. Where we have our oil fields, it's in rural Pennsylvania, it's land that's been in the same family for nearly 100 years. These people are passionate about their land. They also are foresters, they have trees on the land. They are absolutely passionate about what it is that they do and the protection of their land. And yet suddenly as an oil company, you are throwing the book on everything that you want to try and do, because you are now governed by the same restrictions as everyone else. I understand, the danger of an oil spill. It's drastic, but also you need to allow individuals to be, they're in governance of their land. They are doing the right thing, and you need to accept that, because these people are basically trying to earn a living and they're trying to do it the right way. And so therefore, having a one-size-fits-all solution doesn't always work.
I'll offer one more, especially as a 1L. I think at the end of the day, in addition to embarrassing regulators by bringing them in front of Congress, it's also embarrassing to get slapped down by the appellate courts. And the standard really favors a regulatory process that's as complete and long and fulsome as possible. That's in real tension with innovation, and I think you'd have to have some sort of adjustment of the standard of review for regulatory action if we really want to speed along certain regulatory processes. I think we'd want to be careful about where, but that's an interesting idea. If you want to do it as a note topic, talk to me. Elizabeth.
So about 4 years ago, I decided that I wanted to be an angel investor, and one of my primary motivations for that is that I really wanted to invest in things that were going to change the world. And so over the past 4 years, I've met with, I actually was looking at the numbers, I think it's like 1,020 entrepreneurs. And I met some entrepreneurs who were doing amazing things like fighting cancer with nanotechnology. And those things were going to take, $35 million in 20 years to see a return on investment. And I was so passionate about it that I almost thought about doing it. But at the end of the day, what really made me not invest, not in that particular company, which is a global company, it's great, but what really made me not invest in some of the opportunities was because I didn't believe that the people who were running the organizations knew how to run a business. And the most amazing entrepreneurs that I met were doing things that, generalities, but we're doing things that were going to produce a return in 5 years and weren't going to be a game-changing technology. So my question is, do you think that part of our innovation problem is the fact that really interesting entrepreneurs who know how to run a business are not doing things that are going to take longer timelines, et cetera?
I could answer that. At the same time that we set up UPC Capital Ventures, we also set up an entity called UPC Venture Management. And clearly, for us, having worked in a number of different types of industries, what we realized is having the right sort of management team in place was absolutely key. And who better to trust than your own management team? So the model that we basically we propose to all of our potential investment companies is to say, not only will we provide the funding, but we'll also provide the management expertise as well to support you in those ventures. It kind of becomes quite circular, because in an ironic way, you're funding yourself to some extent, but also what you're doing is you're delivering a cost-effective solution. So, for an entrepreneur who has got a cure for cancer, they're not that concerned with monthly financial statements. They're not concerned with reporting to your investment team. They're not concerned with tax filings. So I think having the ability to plug in the management team to support them and allow them to continue to develop their idea, for us has worked out to be a great solution.
Bill, are you seeing any problems along these lines?
Yeah, this is classic stuff. I remember being an MBA student relatively deep into the last century and reading an article as part of a business psychology course. And the thesis of this article was that entrepreneurs are misfits, they're socially inept, they couldn't hold a job. And I thought of myself as a budding entrepreneur, and I was offended by that. And the bottom line is, and it's a huge problem for all of us who invest in early stage enterprises, the inventive mind is not necessarily a good mind for developing a business. And that is just something in human nature. And I'm sure in your experience as an investor and prospective investor, you like all the rest of us talk about founder problems all the time. And part of my life's mission has been constantly trying to refine my ability to judge entrepreneurs who do have the fundamental discipline and people skills and intuition to build a business successfully, and those that are just intractable. And I'm not perfect yet, but I am getting better and better. And it's a lifelong devotion for me.
And there's nothing more exhilarating than when you find one of them out there.
Yeah.
I remember getting a call out of the blue in 1999 from an MD that was starting a company. And I didn't understand a word he said for the first 30 minutes, but I said, holy smokes, this guy is going to succeed. And, by God, his company's public, and they're on the verge of approval of a big drug. And there was something about this guy that, that you just knew he was going to succeed.
So I feel like I see this a lot too, obviously. And it's it's such a challenging dynamic because a truly inventive mind is thinking about solving problems, not about how to make money. Where a real businessman is thinking about how to make money. And usually that involves solving problems, but their first goal is like, how do I put money at the bottom line, right? And great entrepreneurs, I should say great problem solvers, great people that are trying to solve problems that aren't egocentric, that say, let me solve problems and let me find somebody to work with that can help think about the money side. Like those are the guys that I think are most interesting. When you've got entrepreneurs, but most people aren't like that. Like, they think starting businesses is easy, right? I'm going to go buy the book, and I'm going to take a class, and this isn't hard, right? So finding the combination of the skill sets, I think, is so critical, and it's really important. The other side of that, and it's funny to say this because as an investor, I'm guilty of this in almost every single deal that I do. But wouldn't it be really cool if we could, like, for the same way that when you're in the grocery store and you don't want to buy the GMO food, you want to buy the organic food because you want to support the organic business and help that business grow, right? Wouldn't it be really cool as investors if we could literally fund the ideas that we thought were the best ideas and then help them build the teams around them, a la like putting the management in place, to help those companies, help those ideas move forward? But we don't do that, right? We do is, what's the one that's going to give us the returns the fastest? So that's the motivation in making the decisions that we make. So it would be awesome if it weren't that way, but it is. That's the way that our industry is structured. And it would be really cool if we could fix that, but we haven't yet. Some organizations have, but we haven't yet. So, Techstars works on that. We say, we're going to bring in a great team, and then we're going to help them try to find the right idea or massage the idea until they have good fit. But we're not always perfect at it, right?
Yeah.
So.
Can I just make one point on this? I think that when you find, if you're a venture capitalist, you're paid to give more money back than you take in. That's our business model, and hopefully you give a lot more money back, right? When you find an individual who has that entrepreneurial kind of, I got that idea, zeal, with the kind of business acumen, it is literally like finding a unicorn. It is so, anyone on the panel, it's like finding a unicorn. You were like so excited, right? And finding those people is, they may not always be the easiest people to work with because they're strong personalities, and there's one sitting up right there, but you wouldn't recognize him as a unicorn, but he actually is. But when you find those people, that's when this job gets really fun, and that's when awesome companies are built. That's when game-changing companies are built. When you have someone who's got the zeal, the vision, and the ability to actually make it happen and manage. I mean, people spend their whole careers looking for people like that, and Silicon Valley's got a lot of those guys, and they've built great businesses. That's ultimately, to me, if what you're looking for as an investor, if you can find those guys, it's really important. Really important.
What you may not realize, John, is along the same line of sight as Sarah Shoup, who's a female unicorn.
There we go. We got two.
We're at the reception. We have a lot of people putting corners on the page. 2 quick points before we thank the panel. First is that often some of my favorite conversations around the Silicon Flatirons events happen at the reception. I hope that everyone will join me in a beverage of choice next door at the reception. Second, I am so lucky to work with an incredible team. Anna Noskazy is over there from Silicon Flatirons, Cactus. We really lean heavily on our student volunteers. Eli, Greg, other students, please take a bow real quick. Rob in the back, please give them a round of applause, and our fellows as well. Jim, Bill, John, and John, this has been a terrific discussion. Please give them a warm thank you. That's great.